right, today we're cracking open the case of a true Indian industrial powerhouse, a company with a 130-year legacy, Kirloskar Pneumatic, or KPCL as we'll call it. It's this fascinating story where old-school engineering excellence is meeting the crazy demands of the modern market.
And that brings us right to the heart of the matter, the big question we're going to tackle today. Is this 130-year-old giant a total powerhouse that you should be investing in, or has the hype just pushed its stock price way too high?
So here's the fundamental dilemma, right? On one side, you have a business that is just firing on all cylinders. I mean, it's financially rock solid, it dominates its market, and it's growing like crazy. But then on the other side, you've got the stock market, which has seen all this and slapped a very premium price tag on it. And that creates this real tension. Do you buy a fantastic company, even if you know you might be overpaying for it?
To really understand that price, we first have to appreciate just how unbelievably good the underlying business is. So let's start there. Let's look at the bull case for JCPL. Okay, first up, pure market dominance. In this really critical niche, we're talking industrial ammonia refrigeration compressors for things like massive cold storage facilities and petrochemical plants. KPCL holds a staggering 70% market share. They aren't just a player in this space. For all intents and purposes, they are the market.
Now look at this number, 0. That's pretty much the amount of long-term debt on KPCL's books. For a heavy industrial company that makes huge machinery, this is almost unheard of. It's powerful. Think of it like this. It's like running your household with a huge income, a beautiful house, but with absolutely no mortgage, no car loans, nothing. That gives them incredible financial flexibility and makes them super resilient.
And what about growth? Well, over the last 5 years, KPCL's net profit has been compounding at nearly 35% a year. But here's the really impressive part. That profit growth is way faster than their sales growth. That's a classic sign of a company that's getting smarter, more efficient, and just plain more profitable as it gets bigger.
So where does all this growth come from? Well, a massive 94% of their revenue comes from just one place, their compression segment. See, this isn't a company that's spread thin, trying to do a million different things. No, they do one thing: air, gas, and refrigeration compression. And they are absolute masters of their craft.
But don't mistake that focus for being old-fashioned. KPCL is plugged right into the future of India. They're the market leader in CNG systems for gas pipelines, they're already setting up partnerships for the hydrogen economy that's coming, and they're a key beneficiary of the government's big push to boost manufacturing of things like air conditioners. This is a legacy company that's actively building for the next 50 years.
Okay, so the business is phenomenal. I mean, it's a fortress. Case closed, right? Time to buy? Well, not so fast. Every great story has a counter-argument, and it is absolutely crucial that we look at the potential cracks in this otherwise solid foundation. And this is the single most important point. Look at this gap. The market, right now, is pricing a share of KPCL at over 1,000 rupees. But when you run a conservative financial model, what's called a discounted cash flow analysis, it suggests the real intrinsic value is somewhere closer to 500. That huge gap tells you the market is pricing in absolute perfection and massive growth for years and years to come. There's no room for error.
This peer comparison kind of highlights that valuation problem. Yeah, KPCL is strong, but a competitor like Ingersoll Rand actually generates a much higher return on capital employed, or ROCE. In simple terms, that just means they're getting more bang for their buck. They're more efficient at turning $1 of investment into $1 of profit. It shows that while KPCL is really good, it's being priced as if it's in a league of its own, and that might not be entirely true.
And then there's the human element. There's a lingering family dispute over something called a deed of family settlement that has spilled out into legal battles and is now sitting with regulators. Now, while this doesn't really impact the day-to-day business, this kind of uncertainty around governance, it's a red flag for investors. You always want stability and transparency at the top.
So let's bring it all together. We've got the bull case, a fantastic, dominant, financially sound business. And we've got the bear case, a sky-high valuation with a little bit of governance risk. So where does that leave us? What's the verdict for an investor looking at this today?
It all boils down to a pretty clear, disciplined, 3-step process. Step 1. You have to admire this business. It is an absolute operational powerhouse, no question. Step 2. You have to seriously question the price. Is the current valuation leaving any margin of safety? Is there any room for error? And for a disciplined investor, that leads you to step 3. You wait. You wait for a better entry point.
So the final verdict, based on the analysis, is a hold. Now, what does that mean? It means if you're lucky enough to already own shares, it's probably worth holding on for the long-term compounding power of this great business. But for new investors, this is just not the time to be putting fresh money to work at these prices. Patience is the name of the game here. The long-term outlook is fantastic, but the price right now is just too rich.
And that leaves us with this final, critical question that every single one of us has to ask. We've established that Pneumatic is a truly great company. But for any company, it doesn't matter how great it is. At what point does the price just become too high? That's the real takeaway here. Thanks for tuning in.